Hey there, welcome to the show. Welcome to Be the Boss of Your Money. We are all about helping you to make good financial decisions, the best that you can with the information that you have and with the resources that you have. We are going to talk about a couple of things today. Welcome to the show on this Halloween of 2023. We just finished out a spooky down 3 months in a row. Those are the averages. It's basically, it doesn't mean you did better. It doesn't mean you did worse. A lot of you actually did worse than the averages. Some of you did better. And if you're the type of investor where you crowded heavily into the hot trades of the first 6 months of this year, artificial intelligence, big tech, then you, and EVs, right? Electric vehicle stocks, and you're probably licking some pretty bad wounds right now. You're probably down a lot. This is the month right now, October, that just ended, that it seems like the electric vehicle stock mania has popped. And a couple of other hot areas like artificial intelligence have given up the ghost. So, not so easy, which explains why the major averages were down so far in the last 3 months anyway. We'll see what happens for November. We had a big rally yesterday, over 500 points up on the Dow. Not enough to turn a bad October around, a poor month for the market, but it did follow through today, which I think is pretty bullish. And that means for the end of the month, there are probably some investors that were a little bit too heavily into cash that got overly pessimistic. They saw some stocks starting to go back up and they decided, I don't want to get left behind when the train leaves the station. I better start doing some buying now. And that lifted things a little bit today. That's my take. By the way, while you're watching this, leave a question in the comments. You want to ask me a question, whether if you're watching now or in the replay. And by the way, once I do the show, it's always on my timeline. So you can come back later, check it out, watch it at your leisure, ask me a question. I will definitely see it. Words of wisdom, words of encouragement are always, always appreciated. We have my number one, Renee. Happy Halloween to you as well, Renee. Thank you very much. I'm sure your kids are all cute and everything in their Halloween costumes today, and that is the best part, right? To see little kids in the costumes and stuff, all good. We have candy right now all over my office, and I love the 100 grand bar and the Butterfinger. What's your favorite candy? Let me know in the comments. Thank you, Renee. Let's roll a quick intro, and then we're going to get into what happened today, what I see going on, if we're going to have a rally or not, okay? Let's just make sure we get this intro, and here we go. All right, so Dow finishes up 123 points. Look, by any stretch, it's not a bad thing, right? Up 123 points. It's good after yesterday's rally. So now we have a 600 plus point rally in the last 2 days, just for this week so far. Not a bad way to close out the month. And we followed through in the NASDAQ, the S&P 500. By the way, you can't invest directly into an index, but you could invest into a security that tracks your mimics an index. Gold does not seem to want to hold on to 2,000. It's interesting. When inflation was at 9%, gold couldn't break through 2,000. Inflation's coming back. Gold touched 2,000, but not holding it. I'm just not thinking that gold is really the inflation hedge that it used to be. Gold is not electronic. You want to buy gold, trade gold, and like you're a government, you want to put your money in gold, you actually have to go out and buy this stuff. You really want to hold on to it. It's just not the way society works. I'm not saying it can't come back. I'm not saying that gold wasn't a useful store of currency for the last 10,000 years. I'm just saying right now it just does not seem to want to hold a bid at 2,000. The big news, I think, that's really not being paid enough attention to is oil. You see that? Oil down to 81 a barrel. Wasn't it like, weren't we supposed to see like $150 a barrel because of the war between Hamas and Israel? Didn't happen. Doesn't look like it's going to happen. The war is very contained. My own geopolitical opinion, no one is getting involved in this war. Nobody wants the headache. Nobody wants the problem. Nobody wants to stick out their neck for the Palestinians. And quite frankly, um, a lot of countries just don't see the utility in doing that. And they don't see the point of letting in a million plus refugees into their countries. It could be destabilizing. The Kingdom of Jordan actually kicked Palestinians out a long time ago. Egypt does not want them in. That's why they keep the Rafah gate closed on the Mount Sinai Peninsula. And everybody else just pays lip service. And the only thing Iran really does is send them just enough money to arm the militants, but never enough money to actually feed the population and get them what they need. Everything else, aside from weapons, they're basically dependent on stealing a little bit, but mostly on charity. Who else is out there? Yeah, Renee. 100 grand is a great one. What about the Butterfinger? I mean, I think Butterfinger is my numero uno, and I will be eating a lot of those tonight. So that's what's going on with those. The VIX 18, not holding 20. You know, the fact that the VIX cannot go above 20 and hold it, it tells you that investors are probably positioned the way they want to be. They're expecting maybe a few more rate hikes. They're expecting the economy to slow down. And it looks like everyone is ready for a recession because we have been talking about it and preparing for that for just such a long time. By the time it happens, it's no longer a surprise. It'll be factored into the stock market, be it higher or lower. But right now, it doesn't seem like the stock market factors in on the entirety of up or down. It's a sector by sector case. So we had a tough month, but what's expected to go forward for the rest of the year is some pretty good numbers coming out of the banking sector. Remember, banks are still paying next to nothing on checking and savings, but they're putting all that money into short-term treasuries, paying 5% plus. So banks should be making a lot of money, especially large banks, on their net interest margin. It'll be the regional banks and small banks that take a hit because you're not originating mortgages. They're going to get clobbered by bad real estate loans, and they can't even make new loans. And we have a thumbs up from Linda. Lindy Poo gives me a thumbs up right back to you. And here, throw you a. That was corny, wasn't it? I don't think I want to do that in live stream anymore, but I'm so glad to see you here. And what else? So let's go on to the next screen. Let's take a look at. I have the bonds up here. Yes, let's go to bonds. This is the month, October, that the 10-year yield hit a 16, 17-year high, over 5%. Currently, the 10-year is still at 4.92%, close enough for 5. But when it does have a 5 instead of a 4 handle, investors do tend to freak out, and then they start wondering how much higher it could go. Personally, my own personal view is that if 5% in the fixed income bucket allocation of your investments is acceptable, then you should be all over that. And someone said to me, "Oh, it's 5.92%. I really want 5%. When it's 5%, let me know. Maybe I'll put some money into that." And I just grind my teeth when that happens. I really just grind my teeth because of that. If 5.92 versus 5% is what makes a difference for you, you're not doing it right. You're not doing it right. What you have to say is, if the 5% yield is good for you, and by the way, in a 10-year zero coupon, you are getting 5%. I know this because I look at these every day at the 10-year zero coupon bond. You don't have to worry about reinvesting. You don't have to worry about clipping a coupon and reinvesting it back into bonds. This is good for people who do not need the current income. They just want their bonds to grow by 5%. And it's a guarantee because these are treasury securities. So they're guaranteed, backed by the full faith and credit of the United States. So 5% compounding, they're really good in any account, but I think even better in a tax-deferred or tax-free account, meaning IRA or Roth IRA, or health savings account. Okay, so anyway, these are really good things to look at, but short term, 1 year, 2 year, you're getting 5% plus. There's a lot of good places to put your money, and this is why the stock market is having such a tough time trying to get over so many hurdles. By the way, I see KO out there. Hey, KO, nice to see you, man. And Linda gives me the smiley face. Oh, that's so sweet. Ooh, ooh. All right. So, yeah. So, if you want to buy a stock or put your money into an S&P 500 index fund, for example, you are already getting 5% from short-term treasuries. So to put money into the stock market as measured by, let's say, the S&P 500, you not only have to expect to get well above 5%, but the return you expect to get has to be big enough to compensate you for a lot of volatility and heartache over time. So now you really think you have to get maybe 10% or 9% from the S&P 500. So it's a higher bogey. When interest rates were zero, if the stock market could just be flat and you get a 2% dividend yield, you were doing pretty good. But those days are over, and the 2% yield stocks and 3% yield stocks, those consumer staples blue chips people were buying, those have gotten crushed, which is why we always say here on Be the Boss of Your Money, we don't buy stocks because of a dividend. We buy stocks because the underlying company is a good value or it's growing, and we see upside in the price of the stock. If there's a dividend, that's a bonus, but it's never, ever, ever the driving force of why we would ever buy a stock in a client's portfolio. Okay. So Jack, I am so glad you were here. Happy Halloween to you, Jack, because I had to move the show to just my Facebook business page, but here you are on LinkedIn watching me. So I really appreciate that, Jack. But if you go to my Facebook client first page, I should say our client first page, you can check out the show there as well. But I'm really glad you're here, Jack. And by the way, shout out to you, Jack. Thank you so much for the delicious cold water. We have cold water, triple filtered and treated with UV lights every day because Jack is in the office water business, and you should go to Jack if you need that. And let's take a look what else. Okay, we're going to take a look at a couple of things here. Let's take a look at the Dow Jones Industrial Average for the year. The Dow is down a little bit, even with yesterday's rally and today's rally, which is cumulative about 650 points. The Dow is actually down on the year. So it's a major index. It's down on the year. The S&P 500. The S&P 500 is up not a little over 9% for the year. Not bad, but we were up a lot more than that earlier in the year. The Nasdaq, which was up about 35% at one time, is now up. It's up almost 40% at one time this year. Now it's up only 22.78% on the year. And the small cap stocks are down on the year. They're down 5.62% for the year. So this is why it's a tough year, in spite of the fact that the S&P 500 is up a little bit. And so many people are scratching their head saying, I'm doing so badly. Okay. Jack says, thanks for the plug. My pleasure, big guy. So, yeah. So there's two kinds of investors. Are you someone who invests in using exchange traded funds that follow an index, or you're investing in mutual funds that are actively managed? Or are you using individual stocks to build your portfolio? They're all different. I think most of us are a hybrid of two or three of those kinds of investments. But if you're in individual stocks, odds are you're doing a lot worse than the overall market, because your average stock is down more than the index that it's in. It's a pretty shocking thing, right? Because the major averages, in particular the S&P, is really being held up by a small handful of mega cap, super large companies. And I think that's I think that's about all we're going to get into today. I got to go. My kids are having some friends over for Halloween, and I probably should be at the house supervising and handing out candy. So I'll see you guys tomorrow. Oh, one more thing. November 17th is the drop dead date. We have to agree on a whole new budget. November 17th, we now have a Speaker of the House. We'll see what happens. But you know what? I could already see that still nasty out there. All right, November 17th, another thing to worry about. Go figure. All right. On that note, have a great day. Goodbye.